Hello, welcome back to part 2 of our presentation on Investment Appraisal 101, which looked at how to measure company performance. In part 1, we learned about financial statements, which provides the information for the analysis and measurement of company performance. Using financial ratios, this part of the lecture focuses on how to estimate measures of the different dimensions of company performance. I will urge you to have a look at part 1 of this lecture, just to ensure that you have the basis, the concepts, and knowledge to be able to understand this part of the lecture. Now, let's look at something interesting. In my introduction, I talked about or mentioned financial ratios. Now, what are financial ratios? Financial ratios are created with the use of numerical values taken from financial statements to gain meaningful information about a company. The numbers found on a company's financial statements, which are its balance sheet, its income statement, and its cash flow statement, are used to perform quantitative analysis and assessments of the company's liquidity, leverage, growth, margins, profitability, rates of return, valuation, and many other forms of analysis. Now, let's look at some financial ratios that can be used to measure the different dimensions of a company's performance. Now, ideally, there are at least 5 main types of financial ratios you'll come across. You come across financial ratios that measure the profitability of a company. You'll also come across financial ratios that measure the solvency of a company. You also find financial ratios that measure the liquidity of a company. And then there will be real estate specific measures for those of you who are interested in real estate investments. And then there are market value measures for general investments. Before we delve in to look at the specifics of these 5 different types of financial ratios, I want us to look at something called the DuPont identity or the DuPont analysis. The DuPont analysis actually provides us with a pyramid of all the financial ratios, particularly relating to how the return on equity of a company may be computed. So what is a DuPont analysis? A DuPont analysis is used to evaluate the component parts of a company's return on equity, which we'll refer to as the ROE. This allows an investor to determine what financial activities are contributing the most to the changes in the return on equity. An investor can use analysis like this to compare the operational efficiency of 2 similar firms. Managers can use DuPont analysis to identify strengths and weaknesses that should be addressed in a company. So as you can see, to compute the return on equity of any company, you can multiply its return on investment by its equity multiplier. You can also to calculate the return on investment, you can also multiply its net present value by its total asset turnover. And all of these other dimensions of these specific concepts will be treated later on, as we would see. So let's look at profitability measures. Now, profitability measures are a class of financial ratios that are used to assess a business's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time, using data from a specific point in time. Now, profitability ratios are metrics that assess a company's ability to generate income relative to its revenue, operating costs, balance sheet assets, or shareholders' equity, just to repeat. Now, We should also take note that profitability ratios show how efficiently a company generates profit and value for its shareholders. And higher profitability ratios results are often more favorable, but ratios provide much more information when compared to results of similar companies, the company's own historical performances, or the industry average. So let's look at an example of some profitability measures or ratios. The very first one is what we will refer to as the return on equity, or the ROE. Now, common shareholders want to know how profitable their capital is in the businesses they invest it in. Now, return on equity is calculated by taking the firm's net earnings after tax, subtracting preferred dividends, and dividing the result by common equity dollars in the company. Now, let's say net earnings are, let's say, $1.3 million and preferred dividends are $300,000. Take that and divide it by the $8 million in common equity. This gives an ROE of 12.5%. The higher the ROE, the better the company is at generating profits. Okay. So from this slide, you can see that the ROE can be computed by dividing the return earnings after tax of a company by its equity. Okay. And then the second profitability measure I want us to look at is the return on investment, otherwise referred to as the return on assets. And as we can see here, we can compute the return on assets by dividing the earnings of a company after tax by its total assets. Now, profitability is assessed relative to the costs and expenses and analyzed in comparison to assets to see how effective the company is deploying assets to generate sales and profits. So the use of the term return in the ROA or the ROI ratio customarily refers to net profit or net income, the value of earnings from sales after all costs, expenses, taxes have been deducted. So the return on investment or the return on asset is net income divided by its total asset. Now, the more assets a company has amassed, the more sales and potential profits the company may generate. As economies of scale helps lower costs and improve margins, returns may grow at a faster rate than assets, ultimately increasing the return on assets or the return on investment. Now, the third measure of profitability we'll be looking at is what we refer to as the profit margin. So different profit margins are used to measure a company's profitability at various cost levels, including gross margin, operating margin, pre-tax margin, and net profit margin, as we can see here, and referred to in short as the NPM. Now, we would compute the net profit margin of a company by dividing its earnings after tax by its total sales or revenues. The margins shrink as layers of additional costs are taken into consideration, such as the cost of goods sold, operating expenses, and taxes. Now, gross margin measures how much a company makes after accounting for the cost of goods sold. Operating margin is the percentage of sales left after covering the cost of goods sold and operating expenses. The pre-tax margin shows a company's profitability after further accounting for non-operating expenses. And the net profit margin, as we have seen, is a company's ability to generate earnings after all expenses and taxes have been taken care of. And so these are three important profitability measures or ratios that we would look at when we look at a specific example of a company's performance. The second category of financial ratios I want us to look at is what we refer to as the turnover ratios. Now, the turnover ratios measure the value of a company's sales or revenues relative to the value of its assets. The asset turnover ratio can be used as an indicator of the efficiency with which a company is using its assets to generate revenue. The higher the asset turnover ratio, the more efficient a company is at generating revenue from its assets. Conversely, if a company has a low asset turnover ratio, it indicates it is not efficiently using its assets to generate sales. So let's look at some asset turnover ratios available. And in here, I have three of them. The very first one is what we refer to as the total asset turnover ratio. And we can calculate the total asset turnover ratio by dividing the total revenue or the sales of a company by its total asset. And then the second kind of turnover ratio we will be looking at is the fixed asset turnover ratio. And this ratio can be computed by dividing the total revenues of a company by its fixed assets. And then the third kind of turnover ratio is what we refer to as the current asset turnover ratio. And this can be computed by dividing the revenues of a company or the sales of a company by its current assets. Now, because we have treated total returns of companies, it is convenient for me to say that the total asset turnover ratio of a company is similar to the income yield of a portfolio or the income return we talked about when we're looking at the total return of a company. And it is important to note that typically the asset turnover ratio is calculated on an annual basis. The higher the asset turnover ratio, the better the company is performing, since higher ratios imply that a company is generating more revenue per CD of assets. The asset turnover ratio tends to be higher for companies in certain sectors than in others. So in retail and consumer staples, for example, have relatively small asset bases but have high sales volumes. Thus, they have the highest average asset turnover ratio. Conversely, firms in sectors such as utilities and real estate have large asset bases and low asset turnover. Since this ratio can vary widely from one industry to the next, comparing the asset turnover ratios of a retail company and a telecom company would not be a productive venture. So comparisons are only meaningful when they are made for different companies with the same sector. Now let's turn our attention to solvency ratios. Now, a solvency ratio is a key metric used to measure an enterprise's ability to meet its long-term debt obligations, and it is used often by prospective business lenders. A solvency ratio indicates whether a company's cash flow is sufficient to meet its long-term liabilities, and thus it is a measure of its financial health. It can indicate the likelihood that a company will default on its debt obligations. The main solvency ratios we would see today are one, the equity multiplier, the debt to equity ratio, the total debt ratio, and then the long-term debt ratio. Now let's look at all of these in detail. What is the equity multiplier? Now, the equity multiplier is a risk indicator that can be measured by dividing the total assets of a company by its equity. Now, it is an indicator that measures the portion of a company's assets that is financed by shareholders' equity rather than by debt. It is calculated by dividing a company's total asset by its shareholders' equity, as I indicated earlier. So generally, a high equity multiplier indicates that a company is using a high amount of debt to finance assets. A low equity multiplier means that the company has less reliance on debt. However, a company's equity multiplier can be seen as high or low in comparison to historical standards, the averages for the industry or the company's peers. The equity multiplier is also known as the leverage ratio or the financial leverage ratio, and it's also one of the three ratios used in our DuPont analysis. Now, let's look at the second kind of solvency ratios we'll come across. Now, this is the debt to equity ratio. And the debt to equity ratio is similar to the debt to assets ratio in that it indicates how a company is funded, in this case, by debt. The higher the ratio, the more debt a company has on its books, meaning the likelihood of default is higher. The ratio looks at how much of the debt can be covered by equity if the company needed to liquidate. And we can compute the debt to equity ratio by dividing the debts of the company by its equity. And in here, the debt of the equity of a company will usually be taken from its liabilities, as we'll see later on. And then we can also calculate what we call the total debt ratio by dividing the total debts of the company by its total assets. Now, the debt ratio, or this debt ratio, is a financial ratio that measures the extent of a company's leverage. So the debt ratio is defined as the ratio of the total debt to the total assets, as expressed as a decimal or a percentage. It can be interpreted as a proportion of a company's assets that are financed by debt. So a ratio greater than 1 shows that considerable portions of debt is funded by assets. In other words, the company has more liabilities than assets. A higher ratio also indicates that a company may be putting itself at risk of default on its loans if interest rates were to rise suddenly. A ratio below 1 translates to the fact that a greater portion of a company's assets is funded by equity. So the total debt ratio is commonly referred to as the debt to asset ratio, as we would say. And of course, you can also compute the long-term debt ratio by looking at the long-term debt of a company as a proportion of its total assets. Now let's move on to what we'll call as the liquidity ratios. Now it's important to know that liquidity ratios are related to solvency ratios in that they both measure the financial risk of the company. And the difference, as we would see, is that solvency ratios often look at the long-term risk, financial risk of a company, whereas the liquidity ratios focus on the short-term financial risk of the company. So fundamentally, the ability of a company to service its debts within the short term. Now, there are two fundamental measures of liquidity that can be calculated. These are the current ratio and the quick ratio. Now, what are Or what is the current ratio? The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debts and other payables. So a company with a current ratio less than 1 does not, in many cases, have the capital on hand to meet its short-term obligations if they were all due at once. While a current ratio greater than 1 indicates that the company has the financial resources to remain solvent in the short term. However, because the current ratio at any one time is just a snapshot, it is usually not a complete representation of a company's liquidity or solvency. So let's move on to look at the quick ratio. So the quick ratio, also called the asset test, is computed by subtracting the inventories from a company's current assets before dividing the result by its current liabilities, as you can see here. So this is the current asset of the company. When you deduct its inventory, which is the goods or services it trades in, and divides the result by the current liabilities of the company, you would arrive at the asset test or the quick ratio. Now, let's also note that the idea of the quick ratio is to show how well current liabilities are covered by cash and by items with a ready cash value. So basically cash and cash equivalents. So inventory, on the other hand, takes in time to sell and convert into liquid assets. So if a company called XYZ has 8 million Ghana cedis in current assets minus 2 million Ghana cedis in inventories over a 4 million Ghana cedis in current liabilities, that's a 1:5:1 ratio, actually. So companies like to have at least a 1:1 ratio here. But firms with less than that may be okay because it means they turn their inventories over quickly. Now, there are other forms or types of liquidity ratios that may also be computed, particularly in looking at how a company is able to meet its debt service obligations. Okay, and in this case, we are interested in looking at what is referred to as coverage ratios. And by coverage ratios, I want to treat two main kinds. First, I want to look at what is referred to as the interest coverage ratio. And it's represented as ICR here. Now, the interest coverage ratio can be computed by deducting the earnings before interest and tax of a company by its interest expense. Okay, so the interest coverage ratio measures how many times a company can cover its current interest payment with its available earnings. In other words, it measures the margin of safety a company has for paying interest on its debt using a given period. The interest coverage ratio is used to determine how easily a company can pay its interest expense on outstanding debt. So the ratio is calculated once again by dividing the company's earnings before interest and tax by the company's interest expense for the same period. So the lower the ratio, the more the company is burdened by debt expense. When a company's interest coverage ratio is only 1.5 or lower, its ability to meet its interest expense may be questionable. Now, let's look at a second form or type of coverage ratios called the cash coverage ratio. Now, the cash coverage ratio can be computed by deducting the earnings of a company before interest, tax, depreciation, and amortization by its interest expense. The cash coverage ratio, or what is simply referred to as the cash ratio, is a liquidity ratio that measures a firm's ability to pay off its current liabilities with only cash and cash equivalents. So the cash ratio is much more restrictive than the current ratio or the quick ratio because no other current assets can be used to pay off current debt, only cash. This is why many creditors look at the cash ratio. They want to see if a company maintains adequate cash balances to pay off all of their current debts as they come due. Creditors also like the fact that inventory and accounts receivable are left out of the equation because both of these accounts are not guaranteed to be available for debt servicing. So inventory could take months or years to sell, and receivables could take weeks to collect. And cash is guaranteed to be available for creditors. The cash coverage ratio is calculated, as we can see here, once again, by dividing EBITDA by the interest expense of the company. And then the last category of financial ratios I want to look at is the market value measures. And here I would treat the first two, and I would ask you to do a bit of research about the last but two ratios as you see here. So what are market value ratios? So some examples of market value ratios, as we'll see, are the price to earning ratio, or the PE ratio. The PE ratio reflects the investor's assessment of those future earnings. So you determine the share price, for example, of a company stock and divide it by EPS, which is the earnings per share, to obtain the PE ratio of that company. So if, for example, a company closed trading at 46.51 Ghana cedis, a share per share, and its earnings per share for the past 12 months averaged 4.9 cedis, then the PE ratio would be 9.49 Ghana cedi. It would be 9.49 actually. Investors would have to spend 9.49 cedis for every generated dollar, for every generated cedi of annual earnings. The second type of market value ratio you will be interested in is the market to book ratio. And the market to book ratio is also called the price to book ratio. It's a financial valuation metric used to evaluate a company's current market value relative to its book value. So the market value is the current stock price of all outstanding shares, i.e., the price that the market believes the company is worth. The book value is the amount that will be left if a company liquidated all of its assets and repaid all of its liabilities. So the book value equals the net assets of the company and comes from the balance sheet. So in other words, the ratio is used to compare a business's net assets that are available in relation to the sales price of its stock. The market to book ratio is typically used by investors to show the market's perception of a particular stock value. It is used to value insurance and financial companies, real estate companies, and investment trusts. It does not work well for companies with mostly intangible assets. This ratio is used to denote how much equity investors are paying for each dollar or CD or pound in net assets. The market to book ratio is calculated, as you'd see, by dividing the current closing price of the stock of a company by the most current quarter's book value per share. Now, this brings us to the end of part 2 of section on investment appraisal 101. Once again, if you have not taken a look at the part 1 of this presentation, kindly do, because it will help you to be able to understand the discussion we've had here. Thank you.